spend the next hour and a bit talking about new trading strategies, and we're going to kick off with a panel. And the panel, we're going to discuss a, hoping, quite a controversial topic about the pros and cons of discretionary versus systematic trading. And just to kick it off, I'm going to ask each of my panelists to introduce themselves and just describe what they think, how they define what a systematic trading strategy is versus a discretionary trading strategy, and where they sit, and what's their preference, what's their firm's sort of speciality. It might be both, it might be one or the other. So starting with you, Zem.
Hi, I'm Zem Sternberg. I run a firm called Lake Hill in New York. So the question is discretionary versus systematic.
Quantitative, if you like.
I guess our view is that we are systematically discretionary. We basically try to automate everything, but that doesn't mean we are so systematic that we fly it into a mill. That's the way we look at it.
Okay. Paul.
I'm Paul Chappell. I'm founder and chief investment officer of Seaview Limited. We're a currency hedge fund currency manager. We've been going for 18 years. And as regards the axis between fundamental discretionary and systematic, I'm a complete charlatan, because for 18 years we've had nothing other than a systematic discretionary, a discretionary fundamental program that basically follows and looks for currencies to move towards some form of fundamental value driven by underlying economic criteria. But in the last year, we've launched a systematic program that does pretty much the opposite, that uses entirely algorithmic and mathematical processes to arrive at trading strategies. So in that regard, we kind of, we cover the waterfront.
And my name is Alessio Delongis from Oppenheimer Funds. I run a currency overlay program within our multi-alternatives fund of funds or fund of strategies, as well as I had the macro strategy group for the asset allocation group of the multi-asset group. In terms of philosophy, I would say on the currency side, we run a very systematic research approach to currencies, so we look at currencies through the lens of systematic strategies, which we then implement on a discretionary basis with an additional discretionary overlay on top. What I mean is that we are very quant and empirically driven in nature in our research process, and we like to look at the macro themes driving effects through the lens of systematic strategies. But then we implement those as well as factoring current market dynamics that we think cannot be captured through our systematic strategies. And those two factors we do on a discretionary basis.
Okay, my name is Victor Lebreton. I'm managing director at QuantHedge. I'm the head of the investment management. We are running a purely systematic CTA short-term fund and strategies. So typically systematic guys, investing with algos, trusting the algos, the statistics and the numbers. The only, I would say, discretionary view we have is more not really for the trading, but for informing or advising our algos that the global situation of the market may not be good to trade in a systematic way now. So we're just stopping the algo in case of we have some discretionary input from the market saying there is bold moves, stop trading.
Right. So that's interesting. So I think we have a nice range. So your new fund is interesting. I want to come back to that in a second, but. So from the pure point of view of a pure systematic strategy, what is it that makes you turn it off to stop, to use Zem's word, flying into a mountain? What are the kind of things that you would
typically
look for?
What things is that is, people say you look at the market, you look at the performance market, the volatility in the market, you build some nice, Bell distribution curves and so on. You say, yeah, we have fat tail stuff, there is problem around that. What happens that typically, or you have fat tails and macro event, which is moving in one direction in the market, and you can, interpret that in a way, or you have no event. It's no fat tail. This is a problem. Let's say it happens typically on the CHF. You know, no moves,
Sure.
no information in the market, no price information, nothing to trade. So you stop trading the CHF when there's no information, it's not moving. So we were not exposed to the CHF in Swiss franc, typically because there was this kind of information in the market, and it's coming from the numbers.
So that's interesting. So the trigger or the switch that turns the model off is itself systematic.
It's more quantitative than really systematic in its way. It's information which look like not able, to be taken and to push the market and to be taken by our algos. So the algos is trading when there is volatility. When there's no volatility, the algo can't trade, so it's stopping by itself. But we have to implement this model. So this is where, in a discretionary model, we have to think about what happens if the volatility is too high, what happens if there's no volatility, what happens if, the market is stopping something. So that's more this way we are doing, this implementation of more a risk framework, which is discretionary, where, we can stop the algos to trade. Right. It's not really automated in this way. We get some input on that. We had some macro information, popping up windows and stuff like that, stuff we have built around that to get some macro risk. And based on these, kind of factors we have identified, we can, start to stop the algos.
And in the sense, you talked about sort of not flying into a mountain. How do you guys try and approach that in terms of sort of turning the systematic approach on and off?
I think ultimately it depends on the business. What business are you in? Right. So just to give some clarity, just to give you an example, our business is to provide liquidity in the options market across broad spectrum exchange traded products. So without getting into too technical details, options are like insurance. So if you're going to buy and sell insurance, underwrite, and so forth, you have to do it in a sort of automated, law of large numbers. I guess you'd call it a systematic. An insurance company is systematic, or if you own a hotel in Las Vegas, it's systematic in that sense. So we, in that sense, run our business because by definition you have to run it sort of over and over and over to get the law of large numbers. So for us, that's how we would call it systematic. We tend to not use the word systematic ourselves because that also means just unthinking to some people. We're just going to keep doing this over and over again without changing. Then you get the quant guy who says, yeah, but we'll use some machine learning. Okay, well that's just sort of a way of automating their changing algorithm. So to us, we just say we're automated, we're electronic, we run our business the same way an insurance company runs their business, or the same way a hotel in Las Vegas runs their business, over repeatable, law of large numbers. You can define that. Use the word systematic if you'd like. We don't.
It's a really interesting point you raised. I'm just going to ask the audience a question just to check that you're awake. So, okay, systematic. When I say the word systematic, if you think that that means smart, raise your hand. Is that really only one? Okay. The other option is, okay, I'm going to keep it on smart for a second. If the other option is non-thinking, which do you think it is? So, do you think systematic means smart? Raise your hand. Wow. So non-thinking? Raise your hand. Not paying any attention at all? Most people, unfortunately. Okay.
One thing to just to cut you off right away is I think the common denominator is a disciplined strategy, disciplined business. So the key is to be disciplined. If you can be disciplined by running a fundamental macro approach, you're just very, very disciplined. God bless America, or God bless the Queen. But if you're very, if you're very, very disciplined, and the way you do that is by putting it on a machine to keep you disciplined, that's great. So there are plenty of people who that's the key here in the trading business, is to stay very, very disciplined. Now, how you do it, if you call it systematic, automated, whatever. Just the discipline, I think everyone would agree, that's the key to success.
So Paul, you come at this from a slightly different angle, don't you? Because you've had a disciplined, fundamental approach, but then you've seen the need or the gap in the market to launch this, systematic approach, for want of a better word.
Yeah,
quantitative.
It really is just, there is not as much dissimilarity as you think, because if you think about what we do and have done for a considerable number of years from a discretionary standpoint, we're looking at economic variables driving fundamental moves in currencies. Yeah. You can model that. we are looking at events and short-term opportunities predicated upon, rate announcement, news events, surprises in the marketplace to which we react to. You can, to a large extent, model, when announcements are going out, when an FOMC is going to occur, when there are changes in policy, you can model around those types of events as well. So there's an element to which you're absolutely right. What you have is you have a disciplined, fundamental approach. Most of what you're doing could actually be done and can be done and can process considerable amounts of information on, via machine. And really the distinction between, the real distinction between discretionary and discretionary and systematic is really that as fine as that, because the processes are actually not dissimilar. It's just who's undertaking. And
right.
that's become our conclusion. And it's interesting when you look at the performance of currency and currency managers over a protracted period of time, and particularly over the recent past. The simple reality is really twofold. First of all, in times of quiescence, when there's very low volatility, performance is hard to derive. And it's very much a moot point. Once you get to a point where, as we've seen in the last 6 months or so, a dislocation in economic performance that is driven by some fundamental underlyings has actually driven a change in volatility that's presented opportunities both for discretionary managers and for systematic, because there's just more stuff going on you can take advantage of. So to us, the distinction is not that great.
So let's just follow in from one of the things that you said. You mentioned that you felt that there was some things that systematic strategies couldn't capture, and that's why you needed the discretionary element to it. Could you expand on that a little bit?
Yeah, so the timing of the Swiss event is a prime example, right? So there are some, when you conceive systematic as well as the discretionary side, right? When it's part of a research process that uses a lot of empirical analysis and quantitative analysis to investigate certain phenomena, the first question, and probably the only question you have to ask yourself is today's world part of that sample that I investigated? And I am appalled when I see quantitative programs that, after what happened with the SMB 2 years ago, still retain the Swiss franc, retained after September 2011, the Swiss franc as part of a carry strategy, kept it throughout the peg, and are keeping it today. Right.
This is to Victor's point, right?
But the point that I'm trying to make is exactly that. So you back-tested a 20 years worth of data where this was a free-floating currency, then it pegs. Why are you still keeping it there? Because you really have if that doesn't define a new regime, how can you have any confidence, right? That's part of your sample. And now that you're depegging it and you're going to a free-floating, it's not that automatically means you're back to the old regime. This is a new currency. You have to invest, you have to have enough data to really see how does it trade, how does it perform, what are its main characteristics, what is it beta to the euro, what is its beta to other risk factors, right? So that is the kind of discretion that sometimes you need to overlay when you have a trading strategy, an event occurs and you have to decide, do I need to take this currency out of my program or not?
Right. Just expanding more broadly from, for instance, the Swiss franc example, and I'm going to ask this to all of you, is that do you think there are certain kinds of market conditions where one style benefits over another, or is it simply just that the FX market is in either a bear market for returns or a bull market for returns? So for instance, let's start with you, Victor. So in the last year or so, fundamental managers have done well. What about quantitative managers?
Well, I remember some conference I went to 2 years ago. It's a Quant Invest conference, happens in Paris every year, and we have all these quant funds coming in saying, I'm a macro systematic, I'm a short-term systematic, I'm a long-short quant equity, blah, blah, blah. I'm doing all my models, and then from my models, I decide to trade, in a discretionary way. So my models are as you said, is more a quantitative indicator that it's the right time to trade, but I decide when I trade. You know, if it's too
Yeah.
early, if I need to do it too late, or then you say there are other people saying we have same algos, same models, but we trust that we can automate it that and it's systematic the way we execute on the market.
So how do you differentiate yourself on that? This is
So let's take an example what we do. So we know the market is moving every, let's say, Wednesday and Thursday because all the news are, you know, moving the market as is statistically. If you know, same way, you got your beautiful bell curve and so on, and you see that during the week. So we say it's moving at this period. So there is always a peak of volatility during these 2 days. So when you know that, you ask your algos to do some backtest and say, yeah, whatever the news, there will be volatility. So what do? You do one position top, one position bottom, one sell, one buy, and you just wait. And you know the market's going to move in one direction or another. So
if you trade on Wednesdays and Thursdays, what do you do the rest of the week?
That's a good point of systematic trading. I'm doing conferencing, friend. And if you go in this, let's say, discretionary way, what you're going to do, you may have this kind of algo saying, yeah, I know there is some news because news are public. So what you do, you phone your brokers, you phone your colleague, you phone some other guy or your friends in other funds saying, what do you think about the announce of the French government, of the US government, what's going to happen? And then you can try to find information advantage regarding your knowledge of the market and your relationship in the market to find the right direction of the trade. And this is my point of view of discretionary trading. It's getting your own information by yourself and not directly by a model. The model can help you, why not decide? But you may be decided, they say there is an announce at 4 in the afternoon, and finally it's delayed. Maybe phoning to the other people, you'd say, yeah, we know it's going to be delayed. Well, the algo will never know that.
Sure.
I think you got an answer to your question, then without realising it to some extent, because obviously you don't have a particularly close relationship with the National Bank. If markets only move predominantly on Wednesdays and Thursdays, then you should have got the Swiss National Bank to do paper not on a Monday, because that would make a difference. Right. And that might be the answer to your question about, there are times when, from a discretionary standpoint, events can occur that trip up, as we were sort of saying, change dramatically the market landscape very quickly.
Yes.
And if a systematic process does not have built into it the experience or the competence to adjust to that, because it just hasn't stretched back to date, has data in it that allows it to react to those sorts of things, then it is likely a discretionary manager is going to outperform in those, who has experience.
Sure.
He's going to outperform a systematic process that just has no parameters about a rapid change like that. So,
one of the interesting things right now, though, of course, isn't it, is so things like the FX, we were talking before, so things like the FX Parker Index, which is a sort of a benchmark of managed performance, has shown positive returns for the first time in a number of years. And obviously, as we've seen, a number of CTAs have also produced very good returns in the last year also. And so it seems to me that the discretionary and systematic approaches have done well at the same time. And I think that's, it's interesting because it makes the point about the distinction perhaps not being as big as we think. But what are the kind of market conditions that drive that? Is it just divergence? Alessio, what would your take on that?
Yesterday I gave apologies for those who were there for the repetition, but we investigated some of these things, right? The market conditions that led to the synchronized underperformance of carry value and momentum from 2010 to 2013. In my mind, so carry, the answer can be relatively simpler. Just convergence in interest rates, of course, dilutes that income signal, right? So you just have, by definition, less income opportunities given that volatility remains more or less the same or higher. But then both value and momentum rely, because of different reasons, they rely on some sort of macro momentum in asset prices. And what was particular about 2010 to 2014 until June was that what are the biggest drivers in terms of market prices of currencies? It's commodity prices and interest rate differentials. If you have lack of volatility and lack of momentum in these two macro drivers, chances are the currencies are not going to have momentum, and either And that affects valuations too, right? Because valuations, you need a break of the previous trend to go the other way, right? But you need a momentum in that following move to gain price action. So in my opinion, we in 2014, of course, the ECB helped, the BOJ helped, but in my opinion, if you look in 2014, we all got a lucky break because of the massive momentum that we got in oil prices, which of course helps disaggregate the currency world in clear blocks, right? First of all, you get a dollar dimension, and then importers versus exporters, and that allows momentums to build in the FX market. But unfortunately, if you, then we were helped by the ECB and the BOJ, but that's a little tricky because the BOJ price action and the ECB price action of quantitative easing gets priced directly into the currency move without going through the interest rate differentials. Because interest rate differentials cannot move. We're at the zero bound and they don't move. The average volatility, the interest rate differentials, has been 20 basis points annualized in the last 5 years. That doesn't make a trade, right? It used to be 100. So the question is, until you don't see a renormalization of interest rate markets, I think we are still in a vulnerable environment from a currency manager's point of view.
Right, interesting. And just to, because Zem, you actually look, obviously, because you're focusing on vol, you probably have a slightly different take on what takes a good environment, what makes a good environment for your returns, for instance.
That's the holy grail. I wish I knew in advance when something would work and when it wouldn't work. I think the key is have a disciplined process and stick to it. You know, there's a very simple strategy that works over and over and over again. It's called indexing. Just buy the index. The index is a quantitative strategy. Stocks are added and deleted in a quantitative, systematic way. Then you buy it, and then you do zero cost dollar averaging, and you just do it. But where are all the billionaires no one does it because something happens and they override it, or they get in or they get out. Reality is, it's a great strategy if you could stick to it. Trend following is also a great strategy if you could stick to it. There's tons of great strategies. I think the issue really is for everyone in the room and so forth, me, you, everyone, is the difficulty of having the discipline to just say, I'm going to do this. I don't know when trend trading is going to not work for 3 years and then it's going to work. I don't think anybody does. So you just have to have a process in place, do it, stick to it, and that's what will separate you from everyone else.
So if someone was, and I met a few people who are actually in the process of doing this, interesting enough. So if you were building a currency process from scratch right now, what would be your, top 3 factors that you, discipline is obviously one, but in terms of actually factors and inputs that you should analyze, what would you?
I feel a little bit like the kid who got put into the wrong classroom. We don't trade FX. So, and the reason we don't trade FX is because we focus only on listed, exchange traded, where the price is discovered on the exchange.
Right.
And there's some edge in FX, but we just don't deal with it. But if you said we trade everything but I would say broadly.
But why don't you expand a little bit on why you don't trade FX though?
Well, for us specifically, for every dollar-yen hedger, there's a dollar-yen-dollar hedger, right? And then the banks are an intermediary.
Buy this and sell it.
For the products that we trade, coffee, sugar, cocoa, lean hogs, cattle, gold, silver, natural gas, crude oil, S&P, Russell, et cetera, there's a bona fide hedger on the other side somewhere hiding in the weeds. These products exist for hedging. It's like insurance. You own insurance,
Sure.
Life insurance, homeowners insurance. It's competitive, but there's a small edge to the insurance company. For those particular products, or even individual equities per se, there's tons of options and tons of business opportunities in all of them, but we just don't focus on them because we'd at least like to know that no matter what your algo, disciplined, systematic, however you do it, we want to know why we should make money and just focus on providing liquidity to the end user and earn a living doing it. So that's the short or
interesting. So we've got 3 currency managers sitting on the couch here. So
what's the
comeback?
There's plenty of money there. That's just not in our space. That's it.
Yeah,
I'm not saying there's no money. There's plenty. It's just not what we do for that very structural reason.
So Paul, what about you in terms of factors?
Well, to answer what you're asking about how you build something from the ground up, what you want to do is to have a variety between, or a combination of factors that are effectively trend following in those times when there are trends, and offset that against, to some extent, things for relative value that participate in a benign environment. And to some extent, that's exactly the technique we employ in our flagship program, is that we look for fundamental moves over the medium term, and we're prepared to stick with those. I mean, that's the trend following component of what we're doing. We're looking for currencies to eventually assert or reassert themselves to that fundamental value, irrespective of the attempts by governments and governmental agencies and interest rate adjustment policy to prevent that from time to time, which causes sometimes some blow-ups and big opportunities. But contrary to, on the other side of that, we're short-term trading on an opportunistic basis, sometimes to hedge those underlying exposures and sometimes to add value to them. I mean, just as events roll out on a day-by-day basis, the short-term trading is almost like trying to take opportunity of the noise that is in the volatility that's available within marketplaces, alongside having an underlying view. And to us, to deliver good risk-adjusted returns, you need to have a balance between those two components.
Okay, interesting. Messier.
Yeah, I would divide the answer in two sections. Maybe from a macro factors point of view, I think you need to have a good grip on inflation, commodities, interest rates, and some economic-based measure of the staging of the business cycle in which that currency is in. What I mean by that, why do you need a firm grip on some pure economic variable model, is because we used to look at interest rates as the market-based signal of monetary policy expectations as well as growth differentials. But as we know, in the zero interest rate world, interest rates have lost that signal power, right? So you need to, you can have growth outperformance in an economy, and it's no longer reflected in the interest rate because the policy is so far away from worrying about growth, and you are fighting deflation, right? From a different dimension, not macro factors, but rather statistical behavioral factors. I think you do need you need to be mindful of, are your models belonging to do they rely on a momentum type of environment or on a mean reversion type of environment, regardless of the macro factor you're looking at.
I want to just twist the question a little bit for you, if I may, just following on from what Alessio said, which is, on what kind of frequency do you need to change the models that you're running, or do you have do you come up with a?
Well, there is there's a mix of a question. I can answer both questions. So
sure.
First factor is that what is your investment style?
Yes.
Are you short-term trader, long-term trader? Do you want absolute return? Are you long-term guy? Whatever it's currency, not currency. Are you macro trading? So what's your investment style? What's your time horizon?
Yes.
Do you need to stay liquid? So are you going to absolute return, performance style, or are you going portfolio management type with rebalancing and putting some money, taking some off money? Whatever, it's a basket of currency or exposure with bonds and rates and so on, an option to that. So whatever, after that, do I do this management on a systematic way with an automation system, or do I do it whatever I have some quantitative indication that my factor would be I'm the traditional manager. I'm not doing it systematic way. So I'm discretionary in itself.
Yeah.
And then when you have defined your framework or the strategy you want to build, then the factor which would be based on the volatility. If you're very short term, then maybe you have to readapt your model quite often, because the volatility of yesterday is not the volatility of today, neither tomorrow. So your model have to anticipate some kind of strategy change and also performance change regarding the market conditions. Anticipating market conditions is definitely one of the factors regarding the speed you need to turn around with your strategy. There is some other factor, which be an expected event. Can you have some rating system when you say I stop trading everything because I need to get out. I lost money, but I don't want to lose more money. So this kind of risk factor has to be taken into account when strategy. Then there is also the appetite of your clients. It's a factor. Are they putting some money, waiting? Is there some lockup of the investment, or they want to leave the market very fast? You don't know that. The guy can ask you 2 weeks after he's going to leave the market. So you still open a strategy. You say, no, sorry guys, it's not going to happen soon because I know there is, large event coming in. I'm exposed on this kind of portfolio. I don't want, even if it's an algo doing that, algo can expose itself in some way. So say, yeah, I want to leave the market, and maybe you can do that.
You make a great point on the time horizon and the kinds of investors that might be attracted by a certain strategy. Paul, I'm interested from your point of view that since you've had this long-running fundamental strategy and you've got your new systematic one, have you noticed any difference in the kind of investors that is attracted into the, is the fund, my assumption would be that the fundamental one would be more long-term investors and the systematic one might be more short-term, but
yes and no. In as much as that, a couple of things. There hasn't been, perhaps unsurprisingly given performance, there hasn't been a lot of new product launched into the currency space by really anybody much over the course of the last 2 to 3 years because of performance. So we find ourselves in a fortuitous position of launching something new. It actually attracts attention because there's not actually a lot of competition in that regard. The curiosity to some of them about this new systematic program is that it's actually got a 10-year track record, but it was a group of people working within a banking organisation, and we basically ported out that competence and we're delivering. So it's kind of a new product, but with a decent background. The reality is also that there are a considerable number of investors and a considerable amount of investor analysis that goes on that convinces itself that currency managers and hedge funds often outperform in the first 2 to 3 years of their existence. And
and then what happens?
and there are a lot of, and there is therefore a lot of opportunity for what are called early adopter investors to look at the new fundamental program because it's only been actually running for a couple of months. So the simple answer to your question is, at this precise moment in time, because it's something new and because it actually is, it is effectively something that is in early stages, there is a different class and type of investor, usually with a stronger risk appetite, who look at those types of opportunities as opposed to the more traditional investor who will want to see 3 years track record, minimum number of assets under management, a whole series of other criteria that is the more traditional investor that will actually be looking more at our programs that have greater longevity.
Understood. It's interesting you mentioned stronger risk appetites. One of the things that came up on our discussion before was the idea that investors might be more forgiving of a discretionary manager if they lose money than a model. Because if the model is wrong, the model is wrong. Whereas a trader, well, they might just been unlucky. Unless you did.
Well, it's funny you bring that up because that would be my question to the audience. I think we should run this. Is through my experience, my impression is that what is fundamental when you decide, and again, we're probably cornered ourselves into this bad definition of discretionary and systematic, right? But if you have to categorize yourself, it's really important that you make the client selection in the sense that you have to really feel that your client speaks your language and understand that they have to be discretionary and systematic themselves. What I mean by that is, I've noticed over the year a tendency for when performance is good, it's easier to sell a systematic program because it is easier from a process standpoint, right? Systematic is usually associated to you have a process. You're not throwing darts at a wall. It's a vetted process from the beginning to the end. There's check and balances in the system. It all feels very taken care of. However, while on the discretionary side, it's more difficult to basically not convey the idea that you just got a lucky trade, right?
To make it repeatable. Yeah,
exactly.
Right.
Can you repeat your success? However, when you are underperforming, you see a very clear tendency of the end investor to say, well, the model is losing money, so the model just stopped working. The model is dead. And there tends to be much more forgiveness towards somebody that labels itself as discretionary, because you can always reconnect the main losing trade to an event. And the psychology is, well, that event is behind us. Maybe that was just a bad accident along the way, and things will go back to normal. With a model, it's more difficult to attribute performance, underperformance to a one-off event, right? And so my question to the audience would be, does this asymmetry of the preference for systematic versus discretionary exist in good times versus bad times?
Well, we've got I think we've probably got a few minutes left. So I'm happy to open it up to the, you guys didn't do very well on your systematic versus non-systematic. So I'm hoping you'll do better on questions. Ken.
Quick question. So Quant back in 2008, systematic trading went through what I categorize as a challenging time during high volatility. We're now in a period where Quant is doing well, momentum's outperforming, but volatility is picking up, and as Alessio said, things still feel a little bit vulnerable. How do your firms think about risk? Which risk factors are kind of you focused on, and how do you disassociate kind of bad volatility from good volatility in systematic?
Yeah, I have some macro risk, the Scrake, stuff like that, where we try to track these kind of macro risks, such as Swiss francs. So it could be other banks also having an impact on their own currencies. It could be some block on gold prices, whatever it is. We can figure any of these kind of accident in the market, and people having some crazy idea around how to change things. We also have factors more like the volatility by itself, but the speed of how the volatility is coming to the market. So this kind of peak event, which are more, and always stronger now. So before the market was moving to some kind of agreed price in 2-3 hours, now it's more than 6-7 minutes. The volatility is the same if you look at it in the long way, but in intraday data, the volatility is peaking quite a lot, because it's really different way of. So now we think it may reach 2-3 minutes before the market finally finds the new right price after news, and we think this is where we can be exposed, because there is slippage, you can't execute, and so on and so on. You have to have faster systems to kind of edge your position if you want to leave the market.
People always seem to, as we did earlier, seem to want to have a definition of what systematic means and agonize over what it is. What's interesting is when you say discretionary, everybody assumes they know exactly what you're talking about. But the reality, somewhat the answer to your question is, discretion is twofold. What people assume when they talk about discretionary currency managers, they assume that you're talking about the discretion of which currencies to be long or which currencies to be short of. The reality is one of the most important discretionary decisions you make is in what size. And changes in size of positioning predicated upon market events and step changes in volatility and the ability to assimilate those into what you're doing is probably the most important part of currency management. It's not getting the right direction, it's actually getting the right direction right in the right size, and if you're getting in the wrong direction, getting it in the right size as well when the market landscape changes.
I think we have time perhaps for one more question, if there is any. If there are any, rather. No. Okay, well, I think just to sum up, I think, so the question about discretionary and systematic trading perhaps was poorly couched. I think what we've learned is that the most important thing is a disciplined, balanced, flexible, well-sized approach, and that there is money to be made in currency, and both approaches can work. And I'm sure we have a lot to learn from commodities as well. They've been a very big driver, so you absolutely weren't the kid in the wrong class. So just let me just show your appreciation of the panel. Thank you very much.
Thank you.